Friends, hope you're well. Welcome to yet another video in our series Finance and Investing Tidbits. In this video, I'm going to talk about a very simple way of investing through which you can generate excellent returns. So, this video is about a two mutual fund scheme portfolio, just two schemes that can generate very good returns. And here, of course, I'm not going to refer to any particular mutual fund. You can create this portfolio in any mutual fund of your choice. And I'm going to talk about the logic of doing it and how by just doing that you can generate far superior returns than what you can generate in a bond fund, in a debt fund, in a government securities fund, in fixed deposit schemes. So, all those on one hand and the simple portfolio on the other, which helps you meet your liquidity requirements, which helps you to ensure that the money is available to you whenever you need it, but at the same time, it compounds well. We all know that what is at the heart of investing is compounding. And this scheme of two mutual funds or two mutual fund schemes can work wonderfully well for generating returns, but at the same time ensuring liquidity for you. So welcome to this video. This is going to be a detailed video, but I can tell you this is going to be worth it. Welcome again. Friends, you would agree with me that simplicity has to be at the core of investing. If we make our investing method simple, we are able to focus on all those factors which enable a superior return. So this method that I'm going to talk about makes it ultra simple, I can assure you that. Once we make it simple, it enables us focusing on the essential and cut the unessential. What I mean by cut the unessential is that quite often a lot of our time is spent on administrative activities, whether the bank has given us the TDS certificate, whether the TDS has been reflected in our Form 26 AS, whatever those details may be. Those are important, but if we spread our investment so wide, a lot of our time gets wasted in those administrative aspects. The essential, on the other hand, is about understanding what enables return on our investments and what are the risks. So once we understand the return and risk potential, we allow returns to happen, we allow our investments to multiply. That's really the focus, and that should be the focus. So the essential should be on understanding the markets, whether they are money markets, bond markets, equity markets. And in fact, by understanding the markets, we are able to align with the market forces. We have all seen people flying kites. What are they doing? They're actually aligning the kite with the wind, with the breeze, and the kite flies. Exactly, this is what we need to do in our investing as well. All that we need to do is just align our investments with the wind. And I'll explain what I mean thereby as we go along. So I'm sure you would be curious. I'm talking about simplification. Have I simplified myself? The answer is resounding yes. I have just 5 shares. I have two savings bank accounts. I have 0 time deposits on the day I'm creating this video. I have no PPF balance. I have no provident fund because I'm not employed in any large organization. I don't have any endowment policies. I have no money invested in any bond fund. So life is very simple. So with that simplification, I'm able to focus on those 5 shares that I have, and I can ensure that they perform. I'm able to take entry and exit decisions. I'm able to book profits, move that money into one of those 5 shares where at that time the pendulum has been the most on the pessimism side, take the money out where the stock is on the high of optimism. So all that I'm able to do in just 5 stocks. Now, the question that may come to your mind is, then why am I talking about a method as it's going to unfold, which is not really based on shares or stocks? Well, that's a method which I'm going to share with you, which I have personally implemented in the past, but I have kind of grown out of that. And what I'm going to explain to you, that two scheme portfolio is ideal for people who don't have time to actually work on stocks, research on them. Let me tell you, there are so many analysts creating videos on stock fundamentals, and those are 15-minute videos. I can assure you that if fundamental analysis was so quick and simple, everybody would have made a lot of money in the market. That doesn't happen. So by looking at analyst videos and buying shares, there's no worse strategy than that. Imagine a popular analyst whose videos are being seen by lakhs or millions of people, or they are writing in the business press and people are reading them in lakhs. It's already a public knowledge, and nobody can generate superior returns through stocks where the stock is so widely researched and known. The entire cream of that return is already taken away by people who are in the know of that stock much before it came in the public domain, right? So thereafter, it's just going to generate market returns for you. So people who have actually had already bad experiences with this kind of investing and who want to simplify their investing using two portfolio schemes or two mutual fund schemes, the video is meant for them. I used to follow that method many years ago, but once I perfected my working on stocks, I no longer have investments in those two schemes that I'm going to talk about in this video. So it's good to make that disclosure. But for those who don't have time to research on stocks themselves, instead of listening to the analysts or reading about the stories in business press and investing in shares and not monitoring them thereafter, and then really suffering over a period, for those, what I'm going to talk about is going to be very useful. So I'm just clarifying that so that you understand my perspective. So as I mentioned, those who can't invest in stocks directly, they don't have time because of their own professional activities, they don't have the wherewithal, they're not able to monitor those stocks on an ongoing basis, are not able to participate in investor calls and all that. Mutual funds are a great option if that is used judiciously. Even that's an area where we are vulnerable, but I'm going to explain how we can take care of our own personal interest. As I just mentioned, even in mutual funds, what creates confusion in people's mind is the plethora of schemes that have been created by asset management companies which manage those mutual funds, right? So we have to cut the clutter and go to the basics and invest in a way that we can understand the logic of it and we are able to ride on it, without much effort on our part. So you will be able to, at the end of this video, derive this confidence that you can actually manage your money by yourself. You don't really need any support from anybody whatsoever, and I'm going to tell you how. Now, in mutual fund industry, there are three entities that we all should be aware of. First is the mutual fund, the trust which holds the money of lakhs and lakhs of investors. So that's an independent entity which is holding all the money. Then there is an asset management company. As the name suggests, it's a company which employs specialists, fund managers, research analysts, administrative staff, operation staff, which will manage the various schemes which have been held under the first entity called as mutual fund. Then you have the trustee company, which is supposed to oversee that the regulations are being followed and the asset management company is behaving itself, and it's not overriding the interest of wide body of unit holders. But in spite of that, there is a basic challenge. What is that challenge? Let me explain. Asset management company, let's face it, is a business. Quite often these companies are listed in the stock market and they are accountable to their own shareholders for their return. And naturally, they have their own business interests which conflicts with the interest of us mutual fund holders, and that's something we need to be very aware about. So what happens is they create huge number of managed schemes. Go to any mutual fund and you'll find huge number of schemes, right? Now this is the situation in spite of the fact that SEBI has prevailed on them to rationalize a lot of schemes, and a lot of schemes have been merged. In spite of that, we have huge number of schemes and people really get confused. Now, one challenge with the managed schemes is that with those managed schemes where a fund manager is applying his or her own mind, selecting stocks, selecting investments after a lot of research, the total expense ratio, the expenses which are charged by the asset management company to the mutual fund where your money is residing is quite high in case of managed schemes. It would be as low as 0.2% per year to as high as 2.5% in respect of various schemes. The managed funds, managed schemes will be absolutely on the higher side in terms of expenses. So what does that 2.5% mean? If you have invested a lakh of rupees and the total expense ratio is 2.5%, 2,500 rupees per year will be taken away by the asset management company from your fund for managing your money. On the other hand, some of the schemes that I'm going to talk about, or the two schemes that I'm going to talk about, the expense ratio charged to them are very low. If you directly invest without going through an advisor, it could be as low as 0.2%, which means on a lakh of rupees, just 200 rupees. If you go through an advisor, it may be 400 rupees, but still much better than the charges which are levied for managed funds. So they will keep on introducing these managed schemes, and the advisors would also promote them because the advisors can also get reasonably good earnings out of those schemes than they would be able to get out of passive schemes that I'm going to talk about. Particularly one of them is a passive scheme called as an index fund, about which I'm going to talk about soon. So clearly introducing these managed schemes or managed funds is a win-win for asset management companies and their advisors. So asset management companies are able to generate high total expense ratio, which becomes their own income, from which they can pay people salaries and give them fat bonuses. You won't be surprised if you find the CEO compensation and CIO compensation of these asset management companies exceeding 20 crores per year, 25 crores per year. Who is paying for those salaries? It is the mutual fund investors who are paying for those salaries. So obviously managed schemes is their way of generating superior returns for themselves and for the company that they work for. The advisors also join the party. So earlier you would remember I had mentioned about three markets, and if we start understanding these three markets, then we can understand the dynamics of investing. So money market, and I'll talk about the money, bond and equity markets one by one so that you get a good hold of it. Before I go to the other two, bond funds out of those three are those funds which invest either in government securities or in corporate bonds. Now, if you're going to invest in either of them or funds which invest in those, you are exposed to interest rate risk. So when interest rates rise, like what has happened over the last 6 months, the bond prices fall. So during this period, in spite of the fact that your money is invested in the government bonds through the mutual fund scheme, which is supposed to be very safe, your prices and therefore your unit NAV would have drastically fallen during last 6 months when interest rates were rising. Of course, I have created a lot of videos and you can explore them on my channel. But just keep in mind that interest rates and bond prices have an inverse relationship. So when inflation is elevated, interest rates are rising, bond prices will tend to fall, right? So last 6 months or so, you would have found that many bond funds have given very low or even negative returns. So therefore, what I would say is that for the risk that these bond funds expose us, they generate much less returns than equity. And therefore, I would say that let's just focus on two schemes or two markets, which are money market and equity. So money market is that market where borrowers and lenders are participating in extremely short-term instruments. Instruments such as certificates of deposit, commercial paper, treasury bills, and also the call money market where banks are lending to each other and mutual funds are also allowed to lend to them. Now, since the duration of these investments is very short term, maximum 81 days, these uh, market or money market poses the lowest possible risk for us. So very rarely you would find that a money market fund has given negative returns to you. Out of 365 days in a year, there will be just a handful days where the scheme has given negative returns. Otherwise, the NAV of the scheme keeps on growing. In other words, you'll always generate a positive return. So this is a very, very low risk investment. You may also find similar mutual fund schemes, title liquid funds or overnight funds where money is being invested in extremely short-term instruments, right? So you could also explore those in addition to money market funds. So whenever we have surplus money, this is the best place to park our funds. You can invest for very short period. You don't have to worry like a time deposit where you block your money for 1 month and yet generate sometimes returns which are equal to or less than savings bank interest rate. In fact, currently the money market rates would tend to be going up because of the tightening markets in India where interest rates are rising. There will be more demand for credit. Deposits may not necessarily grow in tandem with the demand for credit. So you would find that the money market funds which generated very low returns during the COVID period would generate superior returns now. I'm saying superior in the context of the time deposits or savings bank interest. So whenever you have surplus money, this is the best place to park your funds. And it can be very short investment also, just for a week, just for 3 days, just over a weekend. But I'm not really talking about making investments for that purpose. I'm actually talking about creating a long-term portfolio. So what you can actually do is create a pipeline out of this investment over a period of time. And once you build a pipeline, what I mean by pipeline is if you keep on investing in a money market fund over a period of time, and once you cross 3 years uh, in the first investment, or in fact you can say every investment, then every time you sell that, it reduces your tax burden because then long-term capital gains tax applies to you. So create a pipeline of such money market fund, and then once you have built a reasonably good corpus, you can start moving that money to another scheme about which I'm going to explain very shortly. Now, even if you're not able to wait for 3 years and you were to switch to the other scheme based on the logic which I'm going to explain to you, doesn't matter. You'll have to have you'll have to prepare for a little higher tax burden, but that should be okay because finally returns matter more than the tax burden per se. But you have to be mindful of the tax implications. And those of you who are interested in downloading a detailed note on this subject, you are most welcome to see the playlist on my FIN-TRAINICA channel titled Financial Fitness. There are 4 videos of 1 hour 25 to 1 hour 40 minutes. And in the fourth video, there is in the description box a link to an 80-page note that you can download and read for yourself. about various aspects, including the tax implications, and some of the logic that I have talked about today. You'll be able to find that logic in those videos as well in greater detail. And of course, there is investing in shares included as a part of those 4 videos as well, which you may like to explore. Now, you have been parking this money, let's say, in this money market fund. Now, what we should be actually capitalizing on is the equity opportunity. The opportunity in terms of money market is just for parking our money. Instead of just leaving it in the savings account, you park that money in a money market mutual fund. So you start building a pipeline, and over a period of time, as you start studying the equity markets and their behavior, you can start moving money to an equity opportunity. So let me talk about that. Here, let me give you some statistics. Between 2003 to 2022, if you look at the Nifty as on 31st of March 2003 and 19 years later, 31st of March 2022, you will find that Nifty has generated a return of 16%, a little over 16%. During this period, that is 2002-2003 to 2021-2022, economy has grown at 12% on nominal basis. What is nominal basis? Real growth, which is reported in the press, which may be 6, 7, 7.5, 8%. And if you add inflation on top of it, the two together give us the nominal growth. So during this period, the economy has grown at 12%. Now, it absolutely makes sense that the Nifty, which is about top 50 companies in India, has generated a return slightly better than the economy. But let's forget about 16%. Even if you were to take a range between 13 to 16%, that's far superior than the return that we would generate on a time deposit or on a bond. So if Indian economy is going to grow, Nifty is also going to grow. So the logic is very simple. Nifty, which are the top 50 companies, themselves account for 50 to 60% of the collective market capitalization of all companies in India. So if that is the case, it gives you a good surrogate as a measure of the economy. So if Nifty has generated 16% return in the past on the backdrop of economy growing at 12%, and if the Indian economy is also poised to grow similarly, so would Nifty. That's the simple logic. So what we should be doing is moving our money from money market funds to the Nifty fund. Now let us observe something here. Now here I have just shown you, this is not something which is based on real data, but just for you to get a perspective, I am showing you a graph of the economy growing. So there is a very minor fluctuation, some seasonal fluctuation, but the economy keeps on growing. Maybe if you were to take into account COVID, there would be a drop in that quarter, but again, there was a recovery after that. But if you observe Nifty or the stock market, what you will find is that the Nifty does not grow in a very similar way. Nifty grows in a more violent way, if I could use that term, right? So it is like a pendulum, where the pendulum seesaws between fear, where you see it on the lower side, and greed, where it goes to the higher side, much beyond what the economy would suggest. So what we should be doing is taking advantage of this up and down, a wavy pattern of the Nifty, shouldn't we? So we should not be following the SIP route, because SIP, this is another myth that this is the best way of investing, and I have created a video on myths and reality, SIP myths and reality. So do explore that video, which is available in the description box. But the point I'm making is that what really has to be observed is this wavy pattern, and we should not invest when the markets are riding high. We should rather be investing when the markets are going through a low ebb. Now your question would be, how do we recognize that? Is there a tool? Yes, indeed, I have developed a tool, and I'll provide that tool in the description box. So use that tool to make an assessment. For example, my tool is currently telling me that on the day of creating this video, which is July 3, 2022, equity markets in India are providing a great opportunity to invest. So this is the time you can move your money from money market scheme to a, to a scheme which invests in Nifty. Thus, instead of following the SIP route where we keep on investing irrespective of whether the market is in a trough or whether the market is booming, we should rather control equity investing by understanding the market cycle and putting the money to work during the trough or when it is going through a low tide, so to say. Now, of course, there are black swan events which can result in steep fall in equity markets, like what happened during the COVID times. In fact, I'm sharing the link of my video which I had created on April 4, 2020, when we were in the thick of the COVID pandemic and a lot of uncertainty was there. And at that time, I had indicated how that was a great opportunity. So the steep fall, of course, can shake us, but once we know that this is a temporary phenomena, and markets always, ride over these temporary problems, we would be able to generate superior returns by again putting more money to work during these difficult times. So gradually, as we start, understanding the market behavior, we are able to take advantage of it, and we don't get under an undue burden. So, is it difficult to time the markets? The mutual fund houses keep on telling us that nobody can time the market. The reality is that all the fund managers, when it comes to their personal investing, time the market. But to the world, they keep on telling us that nobody can time the market, and that's why they promote the SIP route. As I mentioned earlier, I will be sharing the link to the tool in the description box, and you can easily download and just check for yourself where the market currently is. But to my reading, market is a great opportunity for buying right now, the day I am creating this video. So at that time, obviously we can't get the exact bottom, but we are able to gauge that the market sentiment is very bad, and therefore gradually through structured buying, we are able to put money to work. We should not rush to buy in one go, because the markets can always surprise us on both sides, on the lower side and on the higher side. But clearly, once we know that this is a great time to buy and the market is on the lower end, we can gradually start putting money to work and take advantage of it. On the other hand, when the markets go to extreme high, and again the same tool that I have provided in that video can be used to gauge market highs also. And at that time, we can book profits and move money back from an index fund into a money market fund. In other words, these two schemes can be used to move money depending on where there is a potential to generate return. So if the market sentiment has gone too positive, we can move money from index fund to the money market fund. When the sentiment is very bad, very weak, at that time the money market fund's investment can be moved into index fund. And this is the way I actually manage my money earlier along with my equity investing. But as I started allocating more and more money to equities, obviously I have not been participating in this activity, but I can tell you an example of how I did that during the 2016 to 2018 time frame. We all know that the government of India took the demonetization decision, and the equity markets collapsed. They were very fearful what will happen to the economy, particularly the black economy. So Nifty came down to 7,900 level. Again, I could not catch the exact bottom, but when the sentiment was very weak, beginning from November 2016, I started gradually putting or rather switching money from money market fund into an index fund. And every day practically I was putting some money, and then almost 40 days I kept on doing that, and it accumulated a reasonably good amount in the index fund. Come February 2018, the same index went up from 7,900 about 15 months earlier to 11,300. Remember, I'm talking about February 2018. We are now in July 2022. So 4.5 years later, the market is from 11,000 had just grown to less than 16,000. So you can imagine, how the positive momentum that time was. So I then switched back all my index fund money back to money market fund. Luckily, in those days, there was no tax on long-term capital gains. So whatever money I had put into the index fund, which had crossed 1 year by then, it all became tax-free. Today we have to pay tax when we switch money from index fund to money market fund or vice versa. And you should be familiar with the tax provisions. But what I'm saying is, finally, return matters more than tax, and we should be happy to pay taxes by generating superior returns. So instead of generating very paltry returns through fixed deposits and bond funds, it is much better that we invest in the economy. So one, you have the safety of a money market fund where you can park your money and you can move that to an index fund at the opportune time and again move back. And with these two schemes, you can easily generate an extremely superior return. So, as I said, the simple strategy can generate returns much better than putting money in bond funds, fixed deposits, giving you a much better security, because money market funds are absolutely secure from a safety perspective. They provide or they propose lowest risk, and investing in the economy through the top 50 companies which are part of the Nifty, you're also sure that you are investing in the best part of the economy. And naturally, in spite of all the challenges that the economy faces, the economy keeps on growing, and naturally Nifty will also grow. So again, you are able to have a much superior security as compared to keeping money in a bank deposit in one institution. This is far better that you are putting money into top 50 companies, which include some of the best banks in India. So you are able to achieve that at very low cost of funds, as I already told you in the earlier part of the video. Now, you can do this through any large mutual fund house. They typically have both these kinds of schemes, index fund and money market fund. And you don't have to open multiple accounts. You don't have to, again, in the name of diversification, have 5 index funds and 5 money market funds. Keep in one money market fund and keep in one index fund, but go for a reputed large mutual fund house. So they will not risk their own reputation by doing some silly things. And you will be, of course, assured of your funds being properly protected. So this is the best thing to do. And you'll also enjoy this ride on the markets, and that's where you will generate not only returns but also the satisfaction that you are on top of your investments. So for whom does this work best? I mentioned about this earlier, but just at the cost of repetition, I'm saying this, that this works best for people who don't have time to invest in specific shares. Those who are able to do it, like what I'm able to do now, you can outgrow this strategy which I have described, and you don't have to remain stuck to this strategy. I am no longer in this strategy, but this strategy worked for me very well for many years, and therefore I'm sharing it with you, and you can take advantage of that. And finally, my disclosure, as I already told you, I do not have investment in any money market fund or an index fund now, but I invest directly into equities. 97% of my non-real estate, that is all financial investments, are in equities alone. And the rest of it is in gold and one savings account where I have major balance. But otherwise, I have no debt funds, no gilt funds. I'm just disclosing this so that you are able to understand my perspective, and my only objective of creating this video is that you are able to manage your own money easily without getting into very complex way of investing where we lose track of why we have invested in that particular mutual fund scheme or a share. Rather, we do it with understanding and we take advantage of the market movements. I hope you like this video. If you have, do share it with your friends so that they also benefit. Thank you.